This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 9 of Value Investing. In the last episode, I discussed the first 7 principles that are in owner's manual that Warren Buffett set out for his business operation. And in this episode, I'll continue to talk about the rest of business principles from principle 8 all the way to principle 15. Warren Buffett includes the principle in the owner's manual for his shareholder letter every single year. And there's a reason for that. These are very important principles that every single shareholder should understand when they try to buy a Berkshire Hathaway stock. And that's what Warren Buffett tries to encourage shareholders to learn. All these principles that Warren Buffett and his business partner, Charlie Munger, have in their mind. So before we get into the details to talk about these principles, if you haven't already done so, please subscribe to my channel. There are a lot of interesting topics with respect to value investing. So I'm so excited, so let's get started. Since we already discussed the first 7 principles in the last episode, let's get started with 8th principle. The 8th principle says, quote, "A managerial wish list will not be fulfilled at shareholder expense. We will not diversify by purchasing entire businesses at controlled prices that ignore long-term economic consequences to our shareholders. We will only do with your money what we would do with our own, weighting fully the values you can obtain by diversifying your own portfolios through direct purchases in the stock market." This is very similar to the principle that we discussed in the last episode, principle 3, where Warren Buffett discussed he would only do the acquisition when the acquisition makes economic sense, and when the acquisition increases per share intrinsic value instead of just increasing the asset size. We discussed last time how management can just serve themselves at the expense of shareholders when they're only focusing on the asset size of the firm, because it might be really tempting for them because their overall compensations are directly tied to the size of the firm. And that gives them incentive to do a lot of acquisitions without thinking too much about intrinsic value they are getting and the price they are paying. So what Warren Buffett is saying here is that when it comes to acquisitions, he's going to be mindful about how he spent his money, and also he's going to care about per share intrinsic value. He's not going to issue a lot of stocks which can dilute per share intrinsic value, and he's not going to pay a lot of money because that doesn't make sense because the price is higher than intrinsic value. So this is a good principle, and as I mentioned, it's tied to principle 3 that we discussed last time. The 9th principle says, quote, "We feel noble intentions should be checked periodically against results. We test the wisdom of retaining earnings by assessing whether retention over time delivers shareholders at least $1 of market value for each dollar retained. To date, this test has been met. We will continue to apply it on a 5-year rolling basis. As our net worth grows, it is more difficult to use retained earnings wisely." So this might be a little bit confusing when you just hear this principle for the first time, but let me try to explain to you what it means. So Warren Buffett is basically here saying that he has to generate alpha on top of beta. So he wants to make sure that per share intrinsic value for Berkshire Hathaway has to increase more than S&P 500 market on a 5-year rolling basis. So Warren Buffett has been very successful in terms of beating the market over many, many decades. And he's saying here that he was supposed to measure per share intrinsic value, but what he has done so far, if you look at his Berkshire Hathaway annual letter, the first page of shareholders letter shows per share book value and compare that against S&P 500 gain during that year. The reason why Warren Buffett shows per share book value rather than per share intrinsic value is not because that's correct, but because per share book value is more objective measure and per share intrinsic value is a very vague measure. What I mean by that is you have to calculate intrinsic value in a subjective manner, and intrinsic value can range quite significantly depending on who calculates them. But Warren Buffett were almost certain that per share intrinsic value of the Berkshire is a lot higher than per share book value. And that's why it's okay to use per share book value to be more conservative. And he's comparing that against S&P 500. Another thing to note here is that, as I discussed in the last episode, companies can use their capital and profits in the following ways. First, they can retain earnings to maintain the current business operations or grow current business operations to the next level. Another way of using the capital is through acquisition activities or merger activities, and this is what Warren Buffett does really, really well. The last one is to distribute the capital back to the shareholders in the form of dividends or share purchases. And Warren Buffett did some share purchases before when the Berkshire Hathaway stock price was below 110% of book value, but he didn't really get a chance to do a lot of these share purchases because he only believes that he should do the share purchase when its intrinsic value is lower than the stock price. And he has never paid out dividends because he has this principle that says if he's making alpha for his shareholders, which means he's generating more returns to the shareholders than the S&P 500, he doesn't have to pay the dividends, because once you pay the dividends, the shareholders should pay their taxes to the government, and that's going to be a huge thing. And also, shareholders can take this money and invest in the stock market, S&P 500, and there's no reason for Warren Buffett to distribute this earning to the shareholders because he's making better returns. So that's the logic that Warren Buffett has used. And the last sentence, he mentioned that as our net worth grows, it is more difficult to use retained earnings wisely. What that means is as the capital base grows, it is more challenging for Warren Buffett to deploy this capital in a wise manner to beat the market. When he had very small amount of money in his investment partnership in 1960s, he was able to produce very high returns for his shareholders. But now, since his capital base is so large, it's really hard for him to find good opportunities to deploy this capital. I may have gone off on a tangent here a little bit, but the bottom line here is that as long as Warren Buffett beats the market, S&P 500, as measured by per share intrinsic value, he can retain their earnings for the sake of shareholders and reinvest these earnings in the area of his businesses or acquiring other businesses as he has done before. If he cannot beat the market on a 5-year rolling basis, then he's saying that he has to distribute the money back to the shareholders. The 10th principle says, quote, "We will issue common stock only when we receive as much in business value as we give. This rule applies to all forms of issuance, not only mergers or public stock offerings, but stock for debt swaps, stock options, and convertible securities as well. We will not sell small portions of your company." And that is what the issuance of shares amounts to, on a basis inconsistent with the value of the entire enterprise. Warren Buffett has been very cautious about issuing the company's stocks because what it means is that, as he mentioned, it dilutes the shares of current existing shareholders, so it's not good for them. So Warren Buffett wants to make sure that at least he gets the same or higher value as a result of issuing company stocks. For example, if we get into merger and acquisition deal, and if acquired company wants to get Berkshire's shares instead of getting cash, then Warren Buffett is going through his assessment to make sure that he gets at least the same value. When Warren Buffett decided to issue Class B shares in 1996, he mentioned to his existing shareholders that the current stock price is not undervalued. If that were the case, it wouldn't have made sense to issue shares back then. This is quite different from what other corporate executives preach every day. It's almost taboo to say that your current stock price is undervalued. If you look at corporate executives going on TV, almost all cases they say that they have very rosy and optimistic views on their company, and it doesn't matter what kind of stock price they have at that point. They just mention that the company has very bright future and they can justify whatever P ratio that they have. So it's quite different when Warren Buffett says that Berkshire Hathaway is not undervalued, and that's just the way Warren Buffett communicates in an honest manner to his shareholders and to the people. On the flip side, I want to also mention that Warren Buffett repurchases its shares from the market when the company is undervalued. Stock repurchase is opposite of stock issuance. He applies exactly the same logic. He only buys Berkshire Hathaway shares when the stock is undervalued. The measure that he applies here, as I mentioned a moment ago, he looks at the book value of the company, and if the entire market value is less than 110% of book value, then he thinks that the stock is significantly undervalued, and he get into this stock repurchase program. And he has done so in the past a couple of times successfully, but within very short period of time, the stock price went up above 110% of book value, so he couldn't really rake in a lot of shares back then. The 11th principle says, quote, "You should be fully aware of one attitude Charlie and I share that hurts our financial performance. Regardless of price, we have no interest at all in selling any good businesses that Berkshire Hathaway owns. We are also very reluctant to sell subpar businesses as long as we expect them to generate at least some cash and as long as we feel good about their managers and labor relations." I think that this principle sets Warren Buffett and Charlie Munger apart from other private equity managers. In the past, Warren Buffett has acquired a lot of companies in the name of Berkshire Hathaway, and that was beneficial for Berkshire Hathaway shareholders. He made many mistakes in the past, but still overall results were very, very good and excellent. Warren Buffett didn't really have this attitude when he first started his investment partnership in 1960s. When he acquired Dunstan Mill Company, he acquired the company because the company was selling below working capital value. It was super cheap back then, and he used Graham value approach to buy mediocre company at very, very cheap price. And afterwards, he liquidated the position and the company at a higher price, and he got financial rewards and for his investors. But throughout the process, Warren Buffett had to go through a lot of unpleasant experiences, and later he changed his strategy. So even if he buy mediocre business by mistake, he prefers to maintain the position as long as it generates cash and as long as he likes the management team. And this is quite different from, as I mentioned, from other private equity firms, because what they do is they buy our entire company and they change either management team or change the structure of the company in order to make some financial profits from the acquisition, and they go aggressive and they have exit strategy. But Warren Buffett doesn't have exit strategy when he's trying to buy another business. And this one actually functions as competitive advantage in the acquisition space. The reason why a lot of people want to sell their businesses to Berkshire Hathaway is because they know they're going to be part of the family, and they know that Warren Buffett is going to give them autonomy once the company is acquired, and they know that Warren Buffett is not going to sell their businesses if something goes wrong in the short term. So Warren Buffett provides full support when he acquires the company, and that provides a lot of relief for the founder of the company. Financial gain is important for a lot of people, but that's not all that matters when it comes to selling your business to someone else. The 12th principle says, quote, "We will be candid in our reporting to you, emphasize the pluses and minuses important in appraising business value. Our guideline is to tell you the business facts that we would want to know if our positions were reversed. We owe you no less. Moreover, as a company with a major communications business, it would be inexcusable for us to apply lesser standards of accuracy, balance, and indecisiveness when reporting on ourselves than we would expect our news people to apply when reporting on others. We also believe candor benefits us as managers. The CEO who misleads others in public may eventually mislead himself in private." Warren Buffett is here talking about how important it is to reporting numbers and reporting business situations in an honest manner to his shareholders. The reason why it is important is because it's obvious that shareholders have to understand the business situation in an objective manner. But also less obvious reason that he mentioned here is that he said, quote, "We also believe candor benefits us as managers." What does that mean? So he meant that if the CEO says that our future is bright, we're going to make a lot of money in the future and profits, and if he paints this rosy picture, he will be tempted to manipulate accounting numbers or do certain accounting tricks in order to make the number look nice. He's going to have that temptation. That's just the way human being behaves. If you listen to quarterly calls or if you read a lot of annual letters, most of these annual letters paint really rosy and bright future for the company. Even when they report bad numbers, what they do is they try to make sure that investors doesn't get spooked by the negative news by providing positive news at the same time. I think that's not really good tactic. Wall Street has adopted the mechanism to bring down the price if they sense something negative. But that's not necessarily the case for Berkshire Hathaway, because analysts and shareholders know that Berkshire Hathaway's reporting is reported in an honest manner by Warren Buffett. We can just take his words at face value. We don't have to go into the fine prints of annual letter to discover something unpleasant. So that's quite beneficial for both Berkshire Hathaway shareholders and managers. The 13th principle says, quote, "Despite our policy of candor, we will discuss our activities in marketable securities only to the extent legally required. Good investment ideas are rare, valuable, and subject to competitive appropriation, just as good product or business acquisition ideas are. Therefore, we normally will not talk about our investment ideas. This ban extends even to securities we have sold and to stocks we are incorrectly rumored to be buying. If we deny those reports but say no comment on other securities, the no comments become confirmation." This principle is also quite obvious in that there are millions of followers who are trying to understand what Warren Buffett is buying currently. And there are a lot of investment firms who are trying to ride on the coattail of Warren Buffett. So if Warren Buffett announces what he's buying, then the stock price is going to go up, and it's not going to provide undervalued opportunities for Warren Buffett to rake in enough shares for Berkshire Hathaway. He wants to keep these secrets to the extent possible, but he has to file his quarterly earning, and during that time, his positions will be revealed. I think this is quite obvious, but also one thing that I want to mention here is that he said good investment ideas are rare and very valuable. And this is quite true. Warren Buffett makes very small number of decisions in a year, whereas some other investment managers buy and sell a lot of different securities, and that's just a different investment style. Warren Buffett's investment style is concentrate on a few securities that have very high probability of investment success in the future. So Warren Buffett wants to secure his investment trading secret until he have enough shares in his portfolio. The 14th principle says, quote, "To the extent possible, we would like each Berkshire shareholder to record a gain or loss in market value during his period of ownership that is proportional to the gain or loss in per share intrinsic value recorded by the company during that holding period. For this to come about, the relationship between the intrinsic value and the market price of a Berkshire share would need to remain constant and by our preferences at 1-to-1. As that implies, we would rather see Berkshire's share price at a fair level than a higher level. Obviously, Charlie and I can control Berkshire's price, but by our policies and communications, we can encourage informed, rational behavior by owners that in turn will tend to produce a stock price that is almost rational. Our "it's as bad to be overvalued as to be undervalued" approach may disappoint some shareholders. We believe, however, that it affords Berkshire the best prospect of attracting long-term investors who seek to profit from the progress of the company rather than from investment mistakes of their partners. This is a bit long principle, but what Warren Buffett is essentially trying to say here is that if you're a stockholder and if your stock price goes up, let's say by 100% over the period of 5 years, and if at the same time business made the same progress, for example, intrinsic value goes up by 100%, then you deserve to make that gain as a stockholder. But he doesn't want traders or short-term oriented investors to take advantage of the market fluctuations in the Berkshire's stock price. The reason why he mentioned this one is because he wants to attract long-term value investors who can hold on to Berkshire Hathaway stocks for a very long-term time period. So in order to do that, he wants his Berkshire stock to be at fair value than overvalued. So this is quite different from other corporations. I think I mentioned a similar thing when I was talking about Principle 10 a while ago. But a lot of corporations and executives are trying to boost up their stock price by becoming a virtually cheerleader. And they're trying to paint very rosy future about the company. But that's not necessarily the case for Warren Buffett. And in order to achieve his objective of having a lot of long-term shareholders, he wants his stock price to be at fair value. Okay, finally, the 15th principle and the last one says, quote, "We regularly compare the gain in Berkshire's per share book value to the performance of the S&P 500. Over time, we hope to outpace this yardstick. Otherwise, why do our investors need us?" This measurement, however, has certain shortcomings that are described in the next section. Moreover, it now is less meaningful on a year-to-year basis than was formerly the case. That is because our equity holdings, whose value tends to move with the S&P 500, are a far smaller portion of our net worth than they were in earlier years. Additionally, gains in the S&P 500 stocks are counted in full in calculating that index, whereas gains in Berkshire's equity holdings are counted at 79% because of the federal tax we incur. We therefore expect to outperform the S&P 500 in lackluster years for the stock market and underperform when the market has a strong year. This principle is quite similar to Principle 9, where Buffett mentioned that Berkshire should deliver at least $1 of market value for the $1 retained in the business. What he's trying to say here is that he has to beat the market S&P 500 because there's no reason for investors hold on to Berkshire stock if Berkshire cannot outperform S&P 500 over the long-term time period. Then investors might as well just hold on to S&P 500 for his investment choice. Another thing that Warren Buffett mentioned here is that per share book value for Berkshire Hathaway is far, far smaller than per share intrinsic value. This is not necessarily the case for a lot of corporations that are struggling in their industry, but Berkshire Hathaway, remember, has a lot of outstanding businesses, and these outstanding businesses have a lot of intangible assets that are not recorded on the balance sheet. So by definition, the book value should be smaller than intrinsic value. For example, let's think about Geico. Geico has a huge brand value. Everyone knows Geico, and you see commercials everywhere. But the brand value cannot really be recorded on the balance sheet. So that's a huge piece missing on the balance sheet, and that's why Warren Buffett thinks that per share book value is far smaller than per share intrinsic value. One other thing that Warren Buffett mentioned here is the tax impact. So since book value is impacted by tax, he wants to make sure that he's aligned with his shareholders when it comes to using book value. So book value is going to be underestimated when Berkshire Hathaway makes positive income, which is mostly the case. And if Berkshire Hathaway incur losses, then book value is going to go down less than 100% because of tax impact. So that's why he wanted to communicate clearly here with his shareholders. Okay, we finally completed talking about 15 business principles that are in owner's manual. As I mentioned, it is quite important for you to understand as a shareholder of Berkshire Hathaway and as a value investor to understand how Warren Buffett operates his business. You can glean a lot of great advice from these business principles, so please take a look at actual document if you get a chance, and I'll also put it in my description box for you to reference. Before I end, if you haven't already done so, please subscribe to my channel, and I'll talk about a lot of topics with respect to value investing in the subsequent episodes. Thank you very much, and see you next time.